Intraday trading refers to the practice of buying and selling financial instruments such as stocks within the same trading day, with all positions closed before the market closes. As shown in the image, the trading day typically starts when the market opens, for example 9:30 a.m., and ends at market close, around 4 p.m. Traders aim to take advantage of short-term price movements, entering a trade by buying or entry when they expect prices to rise, and exiting by selling or selling first and buying back later if they expect prices to fall. Candlestick charts are commonly used in intraday trading, where green or bullish candles indicate upward price movement and red or bearish candles indicate downward movement. Because trades are not held overnight, intraday trading reduces exposure to after-hours risks, but requires quick decision-making, constant monitoring of the market, and a good understanding of technical analysis and risk management. A moving average intraday trading strategy, which is commonly used by beginners to identify short-term buy and sell opportunities during the trading day. The strategy relies on two exponential moving averages, or EMAs, a fast EMA, 9-period, and a slow EMA, 21-period. When the faster 9 EMA crosses above the slower 21 EMA, it signals a potential buy opportunity, indicating that short-term momentum is turning bullish. Traders usually confirm this signal by observing price action, such as a strong bullish candlestick, before entering a long trade. Conversely, when the 9 EMA crosses below the 21 EMA, it generates a sell signal, suggesting bearish momentum and a possible short selling opportunity. Again, confirmation through bearish price action helps reduce false signals. Risk management is an essential part of this strategy, where traders place a stop loss below the recent low for buy trades or above the recent high for sell trades. Overall, this strategy helps traders follow the trend during intraday sessions, making it easier to time entries and exits while keeping trades aligned with market momentum. The basic entry, stop loss, and target concept in intraday trading, which is essential for beginners to manage risk and profits effectively. A trade begins at the entry point, where the trader decides to buy a stock based on a valid signal or setup. Once the trade is entered, two important levels are predefined: the target price and the stop-loss price. The target price represents the level where the trader plans to exit the trade with the desired profit if the price moves in the expected direction. On the other hand, the stop-loss is placed below the entry point to limit losses if the market moves against the trade. The green zone in the image shows the potential profit area, while the red zone highlights the controlled risk area. This approach emphasizes planning the trade in advance, maintaining discipline, and protecting capital, which are key principles of successful intraday trading. A popular intraday indicator combination strategy that uses EMA, RSI, and volume together to generate higher probability trade signals. The 20-period exponential moving average, EMA, is used to identify the short-term trend direction. When price stays above the EMA, the trend is considered bullish, and when price stays below it, the trend is bearish. The Relative Strength Index, RSI, helps measure momentum. A buy setup forms when RSI moves up from the oversold zone above 30, indicating increasing bullish momentum, while a sell setup forms when RSI turns down from the overbought zone below 70, signaling weakening momentum. Volume acts as confirmation. An increase in volume during a breakout or reversal suggests stronger participation and improves the reliability of the signal. A buy signal occurs when price is above EMA 20. RSI shows upward momentum and volume spikes, while a sell signal appears when price is below EMA 20, RSI weakens from higher levels, and volume confirms selling pressure. By combining trend, momentum, and confirmation, this strategy helps intraday traders filter out false signals and make more disciplined trading decisions. The VWAP, Volume-Weighted Average Price, intraday trading strategy, which helps traders identify the overall market trend and make disciplined entry and exit decisions. VWAP represents the average price of a stock throughout the trading day, weighted by volume, making it an important benchmark for intraday traders. In a bullish scenario, when price stays above the VWAP, it indicates strength and buying interest. Traders look for entry opportunities when the price pulls back and bounces off the VWAP, confirming the uptrend with higher highs and higher lows. The stop loss is usually placed below the recent swing low to limit risk, while the profit target is set near the next resistance level, often maintaining a favorable risk-to-reward ratio, such as 1:2. In a bearish scenario, when price remains below the VWAP, it signals weakness and selling pressure. Traders enter short positions when price retraces to the VWAP and gets rejected, forming lower highs and lower lows. Here, the stop loss is placed above the recent swing high, and the target is set near the next support level. Volume plays a key role in confirming moves, as stronger volume during price movement increases the reliability of the trend. Overall, the VWAP strategy helps intraday traders trade in the direction of institutional activity while managing risk effectively. Intraday risk management, which is the foundation of long-term success in trading. It highlights the importance of position sizing, where traders risk only a small percentage of their total capital, typically 1 to 2% per trade, to ensure that no single loss can significantly damage their account. Another key principle shown is maintaining a 1:2 risk-reward ratio, meaning the potential profit of a trade should be at least twice the amount being risked, allowing traders to remain profitable even if not all trades are successful. The image also emphasizes setting a daily loss limit, a predefined maximum loss for the day after which trading should stop to prevent emotional or impulsive decisions. Equally important is stop-loss discipline, where traders strictly follow their planned stop-loss levels without hesitation or emotional attachment to a trade. At the center of these rules is the idea that discipline leads to longevity, reminding traders that consistent risk control, not frequent big wins, is what keeps them in the market over the long term.